Sellers failed again. There was absolutely no follow-through on Friday from the bearish engulfer, and although volatile intraday, markets were actually very strong at the exchange level. This week, it's all about a possible melt-up as we head into Nvidia earnings after the close on Wednesday. Welcome to the Trade Brigade Weekly Watch List. My name is Matt, and I'm excited to show you some pretty bullish charts, but also where we might want to remain cautious. If you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure, solid green-bodied bar, very impressive close from the buyers at the top end of the range. Now, admittedly, the range is much smaller than the 2 previous weekly bars, but the strong close is still very bullish. If we're thinking about location on the bar-to-bar count, a massive monster higher low here is almost completely outside of the previous week's range. That, of course, is very bullish, and we can pair it with a higher high as well. Bulls go 2 for 2 on the weekly count, and in the overall scheme of things, the trend that's taking place here, we have lows, higher lows. Remember that these were soft higher lows. And the issue with the August 5th gap down was really the fact that we were getting a lower low, not just from the soft set here, but actually the last higher low in the trend count. So therefore, our concern with the market was that, hey, a lower high here could possibly change the trend on the weekly time frame. As we can all see, we've just made it right back into the equal high. So to preserve the bullish improvements that have taken place here, you really need to see if there are any pullbacks, which once again, there's no indication of this currently. But if there is a pullback, you want to be looking for a weekly higher low to sort of solidify this progress back in the upward direction at this same exact level. The number is roughly 543. If we bring out the Fibonacci's off of the low of this move, not to the all-time high, but the most recent high, it's just a couple ticks away, so it's not much of a difference, but the 38.2 is right at those soft higher lows from back there. It's the same level, once again, 543. If we bring out the anchored VWAPs from the weekly, you're getting a cluster at that same exact spot, so once again, this would be a logical place for a potential higher low. And if we bring out the volume profile here as well, and we'll just drop this to something like a 9-month chart will be fine. And we'll bring this down. Let's go over. If we bring out the high volume node, it's that same exact spot, right? You could even make the argument that you could look for an even better higher low over the upper high volume node, but generally speaking on the weekly chart, I would maintain this optimistic sort of reversal stance as long as we're over that 543. And once again, there's no indication of a pullback looking imminent, but perhaps maybe we back off of the high here a little bit. It wouldn't be a shocker to see something that looks like this into the future. So the weekly chart is bullish, and we now have our key level to watch as potential support. Another thing that we can start to reference here is if we bring out, let's just go to that 3-year chart again, and we'll remove this. I mean, it sounds crazy that we're already back on the topic of Fibonacci extensions, but this Fibonacci extension from the cup and handle, recall this pattern from back here, instead of stacking from the pullback low, stacking from the top, we're just a hop, skip, and a jump away from that target, which is much closer to 571. I'm not going to stretch it entirely, but just as a reminder, this is not in play for this week, but the bull flag from point A to point B, pullback low happening over here in April, right? That measured move target is way closer to like 610 is the round number we had been using in the past. Again, not calling for this week, this month, not trying to get crazy here, but these things start to come at least top of mind as and if we move into blue sky territories, right? Let's drop this down to a daily time frame chart. Now let's get a little bit more granular and more precise with what we should be expecting for this upcoming week's worth of trade. First things first, we'll evaluate the weekly expected move, which is this box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 570.34, almost spot on to that weekly cup and handle measured move. And of course, that's implying a higher high and a new all-time high. If we're contained by the lower bound, the number is at 553.86, and that is a monster higher low opportunity because as we've been pointing out during this entire move back in the upward direction, there has been no higher low pullback that's unfolded. We have never drifted into an hourly downtrend that was sustained to offer a firm daily higher low. So this would absolutely count as a higher low, and the trend would be preserved in the upward direction. Speaking of trend, if you missed out on the Wednesday episode, remember that the successful breakout on Monday really validated that we had a higher high from point A to point B. So the trend is firmly up, again, reinforcing the concept that any pullbacks should be in service of a possible daily higher low. As we made note in the intro, there was absolutely an astonishing failure of the sellers on Friday in particular on the heels of Thursday's bearish engulfer. If you recall, we had made note that we had one time framing in effect where every single daily bar had a higher low all the way up, even into the Wednesday session. Thursday broke that one time framing with a bearish engulfer. We opened on a very mild gap up and we closed underneath not just 1 day's range, but 2 days range. The Tuesday session was completely engulfed as well. The question now becomes, was there any follow through on Friday? And we can all see as clear as day that the answer was absolutely not. There was some volatility, as Jerome Powell was speaking, of course, but where did we close? Right back at the equal highs for all intents and purposes, and the all-time high is quite literally spitting distance away from 562.50, basically the close of Friday, to 565.25. Absolutely, that's in play as we head into the early stages of this week. If we get a very classic inside bar breakout, that's the first thing I'll be thinking about, and then beyond that, we're really looking at that weekly cup and handle measured move target, as well as the upper bound of this week's expected move at 570.34. If stronger sellers were going to get involved in this market, you would tend to think that after Thursday's session on that bearish engulfer, you would have at least tried to look for, as a seller, price acceptance underneath 557 to possibly come in and test this prior high, which was a little bit lower at 553. It, of course, did not take place. There was no attempt to close the gap down here. There's no attempt to touch and test the daily 50 SMA, the blue moving average. Nothing. The strong close at the highs of Friday's session is bullish and again indicates a failure from the sellers to really accelerate after breaking the one time framing and offering a bearish engulfer on the Thursday session. The next thing I want to call out here is the melt up comment we made in the intro, which really stems from some learnings as we were headed into early 2024. If you recall, off of this monster monthly pullback we had back in October of 2023, it was gap and go that kicked off this big rally, right? Well, notice here's a bearish engulfer, we melt higher. Gap up, where's the next bearish engulfer? You sort of get one here, but most importantly, it's this one. Inside bar follows it, and then you get this nice little break in the upward direction, right? You can even look at this. Inside bar continues to melt up a little bit. You do end up getting a stronger pullback over here, but the concept remains that considering we do not have stronger sellers entering this market, I don't think it's fair to say like something like this is in play, or even this for the weekly higher low attempt is in play. Now, that could change if NVIDIA announces absolutely horrific earnings on Wednesday after the close, but we don't make bets on that. As of right now, headed into NVIDIA earnings, we'll be flat through the actual announcement, but the market appears to be much more bullish than bearish, and we'll see this with supporting evidence as well. If there is going to be some sort of consolidation, recall also that this could simply just turn into a bull flag, looking for a breakout over time. If we do find some price acceptance underneath 557, all of those pullback levels we just mentioned and sort of rattled off, 553 and then the gap closed down here, are certainly opportunities for daily higher lows. The trend will not change if these areas can hold up as possible areas of support. Let's take it on down to the hourly time frame chart. We'll get way granular here. And we'll start diving into things specifically from a trend perspective, right? You had lows, higher lows, higher lows. These higher lows, and again, this is just reflective of the daily one time framing we were just describing. Notice the strength and sort of, I shouldn't even say strength, but rather the range that was traveled on Thursday, right? Because obviously we know it wasn't strong if sellers couldn't follow up. But regardless, what I'm getting at here is we got a higher high, and if stronger buyers were going to step in, sure, you would have expected something here. So, okay. On Thursday, it seems as though something's happening where, okay, we're pulling back. Maybe there's some overhead supply. We even broke down and closed underneath this level. Why was it that on Friday, right, opening right here, if strong, like let's play the what if game, right? If stronger sellers were truly going to drive this market lower for even, like, let's not even call it an Armageddon style breakdown. If we're simply looking for a higher low to be found on the daily time frame chart, which is a reasonable outcome, then sellers should have kept the lower high here off of this interaction point, offered a lower high from this to this, right? There's your lower high, consolidation here, and then possible breakdowns to accomplish the tests of these levels that we were just describing. Obviously not the case. You can see on the mid-morning, right, we made an equal high. We sort of pulled back, and there was an opportunity, right? In here, midday, we were underneath that level. Sellers could have even done something that looked like this, offered a daily inverted hammers, something of the sort like this for a daily bar close. That would have been much more dangerous. Clearly not the case. You can see that we rally back into the same exact equal high. You now have lows, higher lows possible. I wouldn't lean into this as a firm hourly higher low yet into Friday's afternoon session, but if you see that the market's supporting over 559.75 early on this upcoming week, absolutely. You're getting these sort of initial indications of an ascending triangle. I would be looking for brigade bolts all day long into the all-time high and possible follow through from there into the weekly target and the upper edge of the weekly expected move, closer to 570.50, let's call it 571, right? So your pathing on the SPY hourly time frame chart is going to look like this. Bullish higher low consolidation in the range. Bull flag breakout is a brigade bolt here. Watching for interactions off of the all-time high, of course, that's a must. If you go through it, it's the same thing into here. If we get some sort of harsh rejection off of the all-time high, I would not short the all-time high. I would look for the pullback, and then you could either get consolidation in here, which would really leave me as being neutral, headed into those NVIDIA earnings really, or if on something like Tuesday's session, notice I brought out the red crayon, if we come back down into range with a lower high, that is the key there, with a lower high right here, you could call it look above and fail, possible pullback from the all-time high, which is fine, right? That's not going to disturb the daily trend at all. And from there, you would target at least the bottom end of the range here at 557. Then we could start to scout for some of these deeper areas. Again, if NVIDIA earnings don't go so swell and we get down towards 553, the gap closes here at the gap close is 544.85. If the bears are going to take control, it's going to require not just like, let's bring out the blue crayon, like this is just neutral consolidation in the range, but the bears, if they're really going to offer something detrimental, it would of course have to be a lower high set on the hourly underneath that 557. That's where the bears sort of make a stand and we say, okay, there's a decent amount of overhead supply. Let's not forget the fact that the daily, of course, can afford that higher low, but is it possible that we should just be looking for a reversal off of something like the top of the gap 549, the closure of the gap fill, right, 544.85 that we were just describing? Absolutely. So sure, you could take this short from point A to point B, sort of looking for this area back here. But as the market makes it there, I would promptly change my tone to something like, where's the double bottom? If we move through the gap range, right? Same concept. Where's the double bottom? Where's the inverted head and shoulders? Where's the hourly hammer candle down here? How can I get involved to try to set a daily higher low at these areas we've just described? And that's really, to me, it seems like a lower probability outcome based on some of the supporting evidence that I'm about to show you in just a moment. And rightfully so, if we were being bullish up here, maybe we should have used the green crayon. This, of course, is where our bulls are really having a good time trading for those all-time highs. So that is the pathing. Let's come in here with some intraday anchored VWAPs. And what, again, like, let's think about this. If you're a stronger seller as you were headed into Friday's open, right? Well, I don't know about you, but it should have been, okay, if we can drop that anchored VWAP from Thursday's open, right? Then this, of course, would have then acted as resistance. It did not into the afternoon. So another feather in the cap for the buyers here, or just the lack of any stronger sellers willing to participate in this consolidation that we've just built out. We just sort of said, if you're looking for a stronger breakdown at this point, it's got to be underneath 557. There's your anchored VWAP from the gap up on this Thursday session of now what was 2 weeks ago, right? If you go all the way back to when we firstly reversed out of the double bottom, I would say that this is the major breakout. Of course, we're above that. So when we get into the lower bound of this week's expected move, just like we talked about reversals for a daily higher low here and here, I would take the same exact sentiment and apply it at 553. We'll finish it off on the hourly with a specific look through this Fibonacci from the bottom up to this most recent high, and the 38.2. This should not come as a shock to many folks, right? We talked about this on Wednesday, really, after we had set this high, is right there. So this is totally, I think, within the bounds of bull flag consolidation, looking for possible follow through in the upward direction. That's your SPY pathing. That's the additional analysis with the fibs and anchored VWAPs. Let's jump on over to the market internals, where in the intro I said, right, the exchange level was strong. If you're not familiar with the internals, check out the video tutorial in the top right-hand corner. But let's focus on, okay, how aggressive, first big question to ask and answer here. How aggressive was Thursday? And then what happened on Friday, right? Well, from a volume flow perspective, it really wasn't all that bad on Thursday. You did not get close to trend lower zone or substantial volume outflows at negative 300 million. If you look at the advanced decline line, yes, it was negative, but it was not in trend lower zone. If you look at the cumulative build, yes, it was negative, but where did we close? Okay, maybe this is the worst indication of them all, which makes sense considering the bearish engulfer printed in the first place. It was not at negative 5,000, but negative 4,000 is getting pretty close to substantial. So we'll give a check mark for the bears out of the tick, but that's it. It's not like we had strong volume outflows as that day was taking place. As we then follow it up with Friday, we absolutely have strong volume inflows closing over 300 million. The advanced decline line is well over the top of trend higher zone, over 2,000 on Friday, meaning basically that everything is over the previous day's close on that Friday session. The tick out of the cumulative also gets to where? Even better than the downdraft that we saw on Thursday. Like this is 4,900, almost 5,000 on the nose there by the time the bell closes at 4 o'clock on Friday. What I'm getting at is at the exchange level, very, very strong. This is a broad-based market improvement that took place on Friday in the face of what started to look like a technical breakdown for even just a daily higher low, right? We're not trying to say Armageddon breakdown, but even just a daily higher low, nothing. No dice, strong follow-up on the Friday session. Again, look at the ratio of volume flowing into up stocks versus down stocks. This is the close of the NYSE. This is the close of the S&P 500 in particular. If I just get rid of this one real quick, let's remove that. And this is the ratio throughout the day's session. I mean, in the morning, we were clocking reads up here that were what? I mean, we're looking at 12 to 1s on the entire NYSE. I mean, the S&P 500 specific closed at 13, but the entirety of the NYSE, absolutely. That's the broadening nature of the market rally and big improvements, and we'll see that mirrored in breadth as well when we get into our supporting evidence categories. Here are the market profiles for the ES futures. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The biggest takeaway here is almost going to marry into our comments beautifully, right? Sellers failed. Notice that value does migrate lower. Point of control does migrate lower on that Thursday session. And what happened on Friday? Blown them right out of the water. Any sellers who were trapped here with terrible location on the Thursday lows made zero progress on Friday. Point of control was higher. Value is overlapping to up. To me, it looks much more like an instance where sellers got ahead of themselves, painted themselves into a corner, and now there's the possibility for a melt up, as we had made note on the SPY Daily, as we head into and approach NVIDIA earnings. There's great excess at the lows here on the Friday session as well. Nice volume taper. So am I concerned about like a poor low that's in need of repair? Absolutely not. This is looking pretty healthy, and I like the consolidation up here. Now, on the flip side of this coin, let's be realists about this. If we were to break down underneath Tuesday's low, which is 557 on the SPY cash, right? This is where we got that sort of nice excess low here on Friday. If we were to take that out, then yeah, of course, now we're going to change tone and say, all right, then the buyers who are maybe looking for the consolidation range to break out didn't make much progress, right? And now we probably have more of an indication of overhead supply. So I still think that this low is going to be pivotal, but the fact that in the most recent memory of the market, because remember, the market has a very short-term memory. Anybody who built a position yesterday immediately has to like follow up with it the next day and so on and so forth, right? So we're less concerned about these traders. We're more concerned about these traders getting pinched out. But if we were to take out this Tuesday's low, Friday's rough low, that's where I think, okay, larger overhead supply, maybe the market does offer that pullback, but based on this failure, I'm not seeing the evidence, just noting where those positions were quite literally held from on Thursday and Friday. So pretty insightful stuff there, I believe, from the market profile paired with the internals here and the follow-up questions we just asked. Let's do the same thing now for the QQQ NASDAQ 100. We'll start on the weekly time frame chart. Let's go ahead and clean that drawing setup, and we will begin. So right out of the gates, there are a couple of glaring differences. We'll keep the script the same, right? We, of course, have candle structure and location. What do we see? That's maybe a little bit aggressive. The bar is actually probably, let's try that one more time. My fault. The upper wick was not as substantial in relationship to the body, but nonetheless, it is a possible inverted hammer. And you'll also notice that we're not even close to the equal high here out of the NASDAQ. So instantly, alarm bells should be going off in your head saying, if you're looking for longs, you probably want to focus on the S&P. If you're looking for shorts, you probably want to focus on the NASDAQ just based purely on the weekly divergence between the two. Look at the distance between where we closed and the all-time high and compare that to what we just saw in the S&P. You'll also notice, I mean, not for nothing, but we are rejecting a little bit the bottom end of that 2-week balance range that we had sort of used as a, Words, pivot point over in the S&P 500, right? The upper wick is suggesting that, hey, we're getting some selling pressure up here. If we bring out the Fibonacci's, right, let's start firstly because we have not made an equal high. We'll start from high to low. We're over the 61.8, and generally speaking, the more bars we can close over the 61.8, I believe, the stronger the odds of a 100% retracement over time. But the upper wick is certainly worth considering. If we bring out the anchored VWAPs on the weekly chart, you are over those as well. So, okay, we're starting to build a little bit maybe more of a narrative that says maybe this is more of a recapture of that area, and maybe, we just want to see either like a very mild pullback and we'd remain more neutral, or continued just inside bar on the weekly, or a higher high would be somewhat constructive. Another weekly close over this 473 would possibly get us looking for upside. But before we move on to the volume profile, I also want to take out the fibs from here to here. If there is a pullback, the 38.2 that you want to see respected is really the top end of this previous breakout area as well at 461.50. So a weekly that tries to do something like this, I believe might remain in play as still looking constructive for possible upside over time. All right, so 461.50 would be that weekly 38.2. Now let's bring out the volume profile, and we'll, just like the S&P, drop this to something like a 6-month chart to start. And we'll see what's going on. We're sort of, again, some alarm bells should be going off. Look at this like high volume node area. It's rejecting in that upper wick. You're not really seeing clean follow through that level into the equal high. And once again, as I've already made note, to me, this just means shorts more favorable in the NASDAQ and longs more favorable in that S&P 500. Let's now drop it on down to a daily time frame chart out of the QQQ. We'll evaluate the weekly expected move and take a look through all of the meaningful indications. So, expected move here, upper bound is at 491.56. Lower bound is here at 468, my apologies, 20, give or take. It's the top end of this gap from over here. So the overall suggestion is a higher high in the recent trend count from here up to here. And I would argue this is still, in theory, a higher low. You have lows, soft higher lows. I wouldn't even really count it as that. Soft higher low here, considering there was no follow through. Still, this could apply some sort of firm higher low on the daily. So the trend change here is still very much so underway. Similar to the S&P daily, not the weekly, but the daily, we do have this indication from a point A to a point B higher high that is on the table right now. So we are technically in a daily uptrend here. And once again, I think this zone can offer a possible higher low. Now, if we're thinking about the one time framing, similar comments emerge here, but notice that the Friday close was not as strong as the S&P 500, and that's really what gives us that upper wick on the weekly bar anyhow. So Thursday does engulf the Wednesday and Tuesday session. We close right at the daily 50 SMA, and then we use that as an equal low on the Friday session. So to me, it's very clear that any sort of breakdown underneath 475 really opens you up to this gap close opportunity on the daily time frame. That's what we would look for if you're a seller trying to navigate a deeper pullback on the QQQ. That's really what you want to participate in. If you're looking for consolidation, then it's exactly that, just bull flag consolidation. Let's not lose sight of the fact that this is absolutely a bull flag. If there is no breakdown underneath 475, it's bullish consolidation over the top end of this previous range, looking for the Swiss cheese gap to close overhead and test that upper bound of the weekly expected move. We've got 488.50 up into 493.10 as the gap close overhead, and that would be a higher high in the trend count, breaking out of this, what I would consider, multi-day balance range as of right now. Let's drop it on down to let's go to the hourly chart. And let's see what else we can learn. There's obviously going to be some nuances here. You can see that we did preserve a lower high on the hourly, so that is in play. If the sellers are going to be strong, you'd like to see another lower high, keep us for consolidation underneath 480.50 as we head into the early stages of this week, right? Then the trend would look like this: highs, lower highs, possible lower highs, and then we start to threaten what? Of course, the issue becomes a descending triangle. Then any sort of lower high brigade bolt here underneath 475 kicks off those pullback opportunities to test the gap that we were just referencing. When we get here, I want to be very clear, right? I know we're talking about a little bit more weakness in the QQQ NASDAQ. when we get towards this gap close area, I would still be thinking about gap fill reversal for a daily higher low, considering that the trend has changed, right? So how might that look? Well, consolidation gives us like this descending triangle. Great. We break lower high in here. It's bearish. If we close the gap, rally, sweep, this is my favorite setup ever. You guys know this if you've been around the channel for any period of time, but the inverted head and shoulders is so insightful because this new low traps a whole new set of shorts. This makes them nervous and possibly gets new longs interested, and then the breakout is the nail in the coffin for any shorts from down here, and you also get not only buyers on the first higher low, but buyers on the breakout. So that's what I would be looking for around this gap close indication. That to me would be a picture perfect daily higher low opportunity, retargeting 475 and ultimately equal highs over time. If we just get big consolidation up here, treat it for what it is, Brigade Bolt over the top end of the range here at 483 is really what gets interesting for a move to test and possibly close the gap overhead. We already talked about these levels. One more time, 488.50, 493.10 is the gap close. If we bring out the Fibonacci's on the hourly from point A up to point B, notice that the lows are not quite respectful of the 38.2. You are testing the 61.8, and if we were to fail the 61.8, which is the key level we just described, that would be great confluence. It would be a loss of the daily 50 SMA as well in blue. It's that moving average, so that's making sense. And we can also come in here with, of course, our intraday anchored VWAPs. We made some progress to close above, not nearly as strong as the S&P, I would argue. If we drop the 475, you're underneath the entire cluster, whereas the S&P still has some underneath you, right? So I think that these additional indications are aligning with the concepts that we've already described in the NASDAQ. Let's jump on over to the NASDAQ internals, because even though we're a bit bearish there relative to the S&P, you still had strong volume inflows. The advanced decline line was well over trend higher zone, and the cumulative tick was positive as well. No issues out of the exchange level, so still bullish at the exchange level, but relative to the S&P, if the broad market pulls back, I would want to short the NASDAQ and stay away from the S&P. If the market breaks out, I would want to long the S&P and sort of let the QQQ be the laggard and do its thing. Let's jump on over to the market profile of the NQ futures, and we'll see what we can see. Notice that this is much different than the S&P, noting on the Thursday session, value did not migrate lower with price, point of control did not either, and technically on the Friday session, you have inside value, but a lower point of control, absolutely. Decent excess highs, decent excess lows. It's a classic inside bar. I would sort of maintain a patient stance if we just go back on over to the QQQ, because of what we just saw, right? Obviously, value is inside here. It's a patience play inside of this range, monitoring for bearish, developments possibly for this descending triangle, but the action item really steps in underneath 475 when we break this confluence, right? Just like to the upside, if it's going to remain sort of like neutral consolidation and we don't really respect that 480.50 for a lower high, this is the action item over the top of the balance at 483, right? And that's really what I've got for you out of the NASDAQ. Let's finish up the broad market with, of course, none other than the IWM. Let's reset this a little bit and get ourselves up to a weekly IWM, and what do we see? So first and foremost, let's clear up the drawing set. Huge improvements back to the upside. Let's not get too sidetracked with, there's some things to talk about here, but let's start with candle structure and location. Solid green bodied bar. The range is as large, if not larger, than the previous 2 weekly bars, so that does seem constructive to me for continued bullish improvements. We're not yet at the equal high on the bar-to-bar count. We do have, bullish interactions here, higher low, higher high, but not yet at the equal high to this sort of squeeze, if you will, from back over here. I think that this is a lot of continued bullish developments. Reason being is this, for the most part, captures my attention. The market easily could have, came up, tested this, failed. And if the weekly bar, we're playing the what if game, right? If the weekly bar looked more so like this, now I'm much more concerned about a lower high, rejecting the overhead supply. We'll see this on the daily chart in just a moment, and possibly failing back down into this balance becomes really detrimental if we're concerned about small caps, and the growth there starts to scream, R word, recession coming around the corner. So we've got some additional indications. Speaking of the R word, we've been talking about KRE, regional banks, recently. We didn't check in on them the past 2 videos, but you get the idea on the KRE. The weekly chart, this massive improvement, the fact that it did not sort of fail here for a lower high and come back down into this range, as we know interest rates are being forecast to be cut, that's a big improvement and sort of starts to get us further away from the R word. The recession word doesn't seem as likely if this is moving higher here. You could say similar things about XRT, which is going to be your retail sector, right? Notice that we're back inside of the range here. We did not set some sort of lower high and come back down underneath. We were very concerned on the August 5th gap down coming back below this overhead supply, but we're basically back up at the equal high. So what's the classic pattern? Look below and fail, targets the top end of the range, we're home. And that's a bullish improvement, staying out of this larger lower balance. And even for like another risk on versus risk off perhaps sector, if you will, could be biotech. It's the same concept, right? Noting that we're coming into these equal highs instead of spending time inside of this consolidation down here. So small caps and using these additional indications to me is a big bullish improvement with the how rapid and aggressive this follow through has been off of the August 5th gap down. As we start to bring in some additional indications, let's begin with the VWAPs here on the IWM weekly. What I want to point out is that the first higher low pullback after the wall-to-wall move 1 to 2, or A to B rather, first higher low pullback back above that, staying above. The pullback from the highest high anchored VWAP here has also been recaptured, right? So that's bullish progress as well. If we bring out the Fibonacci's, there's a couple of takes. We'll come in from the top to the bottom. And you'll notice we're over the 61.8, so odds should increase for the 100% retracement. But also, if we just come in, let's remove that one, and we come in from the low up to the high, we know that we're, of course, over the 38.2 here as well, which is a bullish improvement. And it's been that way. And namely, the point is just reinforcing that we never rejected for a lower high to stay in sort of no man's land in this area here. So the weekly chart is improving out of small caps. I like what I'm seeing so far. Volume profile, just to keep it congruent with the other market indexes we looked at so far. This one, we do want to take a look at the low volume void, right? We've rotated through that quite easily, and now this is kind of the next magnet, or should be magnet for the market. The high volume node is where the market's seemingly most efficient out of small caps, aiming at that equal high. Let's bring it on down to the daily time frame chart now, and we'll jump back over to smalls here. And the main takeaway is Friday's breakout, right? Obviously, the market was very, very choppy prior to that, and the threat was there for the possible lower high here. But Friday's breakout comes on the heels of Jerome Powell's speech at Jackson Hole. Obviously, we know small caps being very sensitive to economic policy from the Fed is a big deal. So the fact that this broke out there is kind of a signal that markets are interpreting Powell's commentary as being just bullish, quite frankly. Not necessarily recessionary or, oh my goodness, the labor market's going to break. Powell was, sort of harping on that nonstop. He really wasn't. He just made brief comment that, hey, we don't want to see continued cooling in the labor market. We do believe inflation's on a sustainable path back down to 2%, even if we do start cutting rates as soon as the next meeting. He basically confirmed there's going to be a cut, and I think the most appropriate cut is going to be a 25 basis point cut, 0.25%, right? I think any more than that gets a little bit dangerous. We'll talk about why in the fundamentals, but that ties directly into small caps and their performance. So Friday, big day to the upside, inside of this overhead range. Huge progress now means that there's plenty of opportunity for a retest higher low over the breakout point and to stay inside of the previous range. That area here is the lower bound of this week's expected move, around 215 flat. If we're just and here's the other deal, right? Obviously, the market's trying to work its way back up towards these highs, but this is just a huge balance. This is a choppy range. I would not be overly aggressive on trades in the IWM, and I would more so use this as a gauge for the S&P. If small caps can stay inside of this range, and even if it's a grindy move higher, if it's slow, it's fine, whatever, but as long as small caps remain elevated, that would be a bullish sign for your S&P in my belief. And once again, your big line in the sand, keep it simple here in small caps, is 215. If you're above, it's bullish. If you're below, a little bit more of an issue. Let's take it on down to the hourly chart. What else can we learn here? Again, put yourself in the shoes of a seller. Let's really, dive into this. If you're a seller, this, of course, is a double top. On Friday, you don't want to see an open here. You want to see an open inside the double top range, possibly for a threat of the lower high there, triggering the double top. 1, 2, here's your neckline breakdown, right? Possibly we could even call it a Man Ray pattern, dare we say. So that would have been bearish, right? Obviously not the case. Huge reaction to the upside off of Powell's commentary and bullish digestion into the afternoon to solidify and, in my belief, really offer more of a confirmation of that move from earlier on in the session. So far so good. This is, of course, bullish, looking for upside. Again, I'd keep it simple in smalls and just use it as a sentiment gauge for your market overall. That's the hourly chart. We can briefly check in. Let's just, again, be congruent Intraday anchored VWAPs, what do we see? Why is this being funky for me? It's not giving me any bars to the right. So let's do it manually. All right, there we go. Over all of them, this is offering confluence at the 218. This is coming from Thursday's open. If you use the gap up, this is coming in here at the 215 line in the sand that we had also just described. Let's take out a fib just for the Friday session from low up to high. 61.8 is slightly underneath the 218. So as long as we're over that, again, I would tend to have more of a bullish stance earlier on in the week. If we started to drop 218, started to become a little bit more concerning for a 215 test. Not the end of the world, but just a test there. Probably some consolidation, maybe a pullback in the NASDAQ, but nothing major. And then if we were to drop 215, okay, now we're starting to question some of the indications that we just walked through. That is it for your IWM. Let's move on over to the Russell internals. Did we get exchange level or really index level confirmation? Yeah, bullish volume inflows over trend higher zone, cumulative build out of the tick. It does start to look a little bit short squeezy to me. This shape right here is always a bit more indicative of a short squeeze versus the 45-degree line, which is sustained buying throughout the day's session. It's not the end of the world because we didn't get back to the zero line into the afternoon, but keeping an eye on that. I want to make sure that stronger buyers are truly getting involved. Sort of this and this would outweigh, if you will, the possibility that maybe that was just a short squeeze. To me, it does seem as though buyers are involved. Even look at the Russell breadth ratio, 17-1 on the close. Some pretty substantial buying volume into the afternoon. Let's finish it up in the IWM, or rather just the Rusty Rut, with our futures and, of course, the market profile. P-shaped profile, no shocker there, considering what the chart just looked like. So, typically that shape would indicate short squeeze, emotional buying, emotional short covering through A and B periods. Value did move higher, point of control was higher, sort of got a normal curve up here towards the top. I think it's, very straightforward. 218 is basically going to be, if you were to get some sort of breakdown underneath value area low, 215 would be back down here around 2190. We had been using 2180 on the Rusty Russell futures. So I would use that 2180 as 215's equivalency from the IWM. And that is your small cap indications. Let's keep this show going with a look through our sectors in the S&P 500 specifically. So first thing is the weekly performance. What do we see over here? Notice that real estate leads the pack on the weekly performance, up 3.61%, followed by materials as well as consumer discretionary. At the bottom end of the barrel, it's the energy sector, and then you're seeing laggards by not being up as much, but still green here. Semiconductors, communications, as well as utilities. So I'm not really concerned with posture. The XLB is a very lightweight sector, but notice that the market was not breaking out big time and trying to set some new all-time high. So posture is not concerning. The fact that we only have one red sector is not concerning. The fact that it's the energy sector, a little bit concerning. Economic slowdown. There's been a lot of talk about that in China specifically. We'll talk about GDP as we get into some of the more fundamental stuff. But let's take a quick look through the charts here and see what's going on. Real estate, nice breakout, interest rate sensitive. When Jerome Powell basically confirmed, yes, we're cutting rates and, hey, it's time to really start dialing things back, changing the Fed's policy, off to the races. So this to me is it's a double-edged sword, right? It's a really lightweight sector. Whenever it makes a new swing high, of course, it's bullish pressure for the S&P. But we know that services, specifically housing services, generally speaking, housing prices, housing costs for consumers, were not the best read out of CPI on the last release. If you recall, it doubled on the month over month from a 0.2 to a 0.4. And the fact that this is breaking out, the fact that Jerome Powell is cutting rates with markets near all-time highs and really housing prices not suggesting on a month over month basis that we've really done much cooling. This was like the best read we had. I think everything prior to that was also a 0.4 or worse. This makes me a little nervous about the inflation rebounding story here and how confident Jerome Powell is in terms of getting inflation to 2% even as they're cutting rates. I think that for this reason, I know we're getting a little bit fundamental here still on a technical chart, the real estate sector and just generally what we're seeing out of this relationship, I think it would be a massive policy misstep if Jerome Powell cut by 50 basis points in the first go around in September. I don't think the Fed is lagging all that much. I don't think that the labor market has broken down all that aggressively. And I know this is a bit fundamental. We'll get back to the technicals, but that's what this chart here specifically is telling me. A 25 basis point cut is the most appropriate thing to do if we're worried about housing inflation coming back and driving CPIs, PCEs back higher. That's my conversation there. Materials, still inside the range, nothing to say. XLY, strong improvements into the end of the week, specifically Wednesday, breaking back out over the top end of this range in here. The engulfer from Thursday, not producing anything bearish, equal highs on the table. Any consolidation over 185.15 is like as bullish as it gets. Even if it breaks down below, I would tend to think that this higher low on the daily is an opportunity. Then you're sort of in the battle of the time frames. Is this a weekly lower high? So in the intro, when I believe I said in that take, some areas where we would want to continue to remain cautious, just kind of be mindful of some weekly lower highs on the sector charts. XLY is one of them. XLI looks great, breaking out to new all-time highs, bullish for the market, no comments there. XLV Healthcare, third heaviest weight sector by market cap, bullish, breaking out to new all-time highs, no comments here, even if it breaks down under 154, so I suppose one comment. Looking for a higher low retest off of 150, no issues, not overly concerned. Consumer staples consolidating up at new all-time highs, bullish for the market, right? Financials look absolutely stellar here. On this breakout through the three equal highs. I was thinking that, hey, pullback's possible, but remember what we said on Wednesday, the lower wick of that Wednesday bar that then closes inside of Tuesday's range, no stronger sellers to be seen. We did get that follow through on Friday. XLK is one of these charts where we want to keep an open mind, right? Possibly a weekly lower high, just like what we talked about in the QQQ. But for now, in the immediate term, I would be thinking more about daily higher low as long as we're over 218, the top end of this previous range. So if we can just consolidate here, fine, call it a bull flag, and over time, excuse me, we'll make some more progress to possibly close the gap and battle for the equal high. If we get under 218 back into this range, some alarm bells should start going off. Some question marks should start firing off. That would be a top watch. XLK under 218 with acceptance becomes a little bit wishy-washy in terms of how confident we are in this reversal. Next up, we've got utilities. Looks fine, grinding away in the upward direction. It's not like it outperformed on the week. The market also didn't break out. Not concerned posture-wise. XLC looks great, sitting at these equal highs. It's all-time high. Consolidation breakouts look awesome. Continued bullish pressure. Even if it pulls back here, higher lows over 85 are fine, noting where we're coming from, not a lower high on the weekly. SMH Semiconductors, lower high on the weekly, yes. Retest of the double top neckline, absolutely. So be cautious of this area. I would tend to say that this is already a little bit more uncertain than the XLK even, noting that this range was already threatened underneath 247.50. I wouldn't say that this is the end of the world, and of course, we still are acknowledging that these higher lows, call it bull flag, call it inverted head and shoulders, it's the beginning stages of a trend reversal, but I think we want to give it the respect it deserves. In here, I would be a little bit more neutral in saying, okay, if this is really going to go for gold, you want to see this breakout probably over the 255.70. With NVIDIA earnings on Wednesday after the close, this absolutely is going to make in my belief, determining move, directional move when that news comes out. TLT is not all that insightful. It continues to compress inside of this range over here between our two extremes that we've been monitoring, no issues. And the energy sector is where we can talk about possible slowdown, R-word, recession maybe. If we're thinking about demand for energy, why are we not having output that requires obviously input, specifically from the energy sector? So the weakness here is not the end of the world. We're not making these huge new swing lows, but definitely not trending higher with the remainder of the market. So keeping that as a back pocket idea as we're thinking about the fundamentals of this market. Let's move into the sector ratios. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The XLK possibly rolling here for a lower high is concerning. The best outcome this upcoming week, and this is going to hold true for a lot of these different looks, would be that we make a new high. If we make a new high in the ratio, bulls on parade, we're looking good. I would tend to feel confident about the bullish nature of the market. XLF has been in this mild pullback. You could call this a bull flag out of the ratio. We know that the structural chart looks great, breaking out to new all-time highs. I'm not worried about that. XLV looks fine, slowly coming back in. XLY, just like the XLK, needs to make a new higher high over the daily 50 SMA, the gold moving average on all of these charts. The XLP, it's trying to set a lower high here. It's the inverse of what we just talked about on this chart, right? You want to see a lower low under the 50 SMA. You want to see a lower low in utilities under the 50 SMA. Watching those closely, sector posture, I think as the market has been balancing, right? If we just go back to the S&P, this is really a balance here. As the market's been balancing, I don't think that this is too insightful. I think that the next move, when the market makes an attempt at a trend, that's where you either want to see confirmation and be confident in the move, or the lack of confirmation and say, whoa, I'm not going to take this breakout. I'm not going to be long here near all-time highs. Utilities should not be, on a relative basis, outperforming, right? That's how you would use this. I don't really think it's all, it's fine when the market's balancing. It's decent to look at, but it's not going to be a make or break. In terms of indications out of the risk on versus off grid, rinse and repeat the commentary. New highs become great, new highs become great, new highs become great. Same thing over here, new highs become great. We'll watch out for that if the market tries to break from the balance range. If the market breaks from the balance range and none of these charts make new highs, again, alarm bells should start going off. Let's jump on into the Japanese yen. We talked about this on Wednesday, and thank you so much in the comments section for allowing me or giving me some leniency on the pronunciation of the Nikkei index, right? Nikkei is how we say that one, apparently. But anyways, this lower high out of the yen set at the 38.2 is right back at the equal lows, basically, yet no one seems to care about the yen carry trade unwinding. And I think it's really because we saw that panic moment. There was sort of a reset from the market. That's max fear. If we start making new lows, and let's flip this to a candlestick chart, actually, so we can see the exact low. If we make a new low under 142, I'll let you guys know, and I'll send out some tweets or something like that, or I'll make some mentions of it in the pre-market shows. A new low is concerning. Just consolidating down here doesn't seem to be the end of the world, especially noting that the Japanese index itself, the Nikkei, actually made it back up to, like, on a relative basis somewhere in here. The move in the USD JPY is really more so attributed, in my belief, to something quite literally like the dollar moving lower on Powell's continued commentary about changing tone about economic policy, right? Or I should say financial policy there from the Fed. So this is why I believe that the yen is continuing to drop in that currency pair, if you will. If we look at gold, as we look at gold, threatening a continued move higher, of course, traditionally would start to suggest, okay, this is kind of a flight to safety looking chart, but none of the other charts we've seen would really reinforce that. So to me, gold is on much more of the territory for a technical breakout of, as we've been talking about for a while, right? This is one of the longest standing cup and handles I think I've ever seen. So a technical breakout more so than a flight to safety is my view of gold currently, especially with the dollar moving lower from Powell's commentary. Expressed as a currency, it would also make sense that gold is headed higher. Rates continue to stay stable, which is a good thing. Remember that interest rate volatility is painful for the market. Oops, circling the wrong thing. Interest rate volatility is painful. Even if it's in theory, quote, right, the proper direction, volatility here is painful for the market, so on and so forth. This, I know it's very short-lived, but it's one day down there. Very painful for the market. So these things, right, need to resolve. And as we're getting this resolution lower, I think that this makes sense based on all the commentary from Powell so far. And a similar comment would be made here in the inverted ZT, the 2-year yield, basically. Rolling over, staying stable. We know that we panicked over there. And of course, now things are resolving. As we take a look at the actual Fed tracker tool, let's jump on over to this. I think the market's possibly agreeing with my stance, which we got into on the real estate sector chart, which is that a single 25 basis point rate cut is probably the most appropriate. Even after Powell's commentary, the odds here remain at 76%, which is, in my opinion, where they should be. Any indication of a double cut, I think, is too much, too fast, and really inappropriate from a services inflation perspective. I would also reinforce that idea. If we take a look at the data that was released last week, it wasn't a lot, but there was some. The labor market seems to be fine. Initial jobless claims came in line with the expectation there. And also, if we just open this up briefly, nothing crazy. We've sort of stabilized after that one massive miss where everybody panicked, and, rightfully so. Things are not looking good on that day, but for now, stabilized underneath this level seems like a healthy improvement. If we take a look more importantly at the flash manufacturing and services PMIs, I know these are flash, so we'll get the revisions later. I think we get ISMs over the next couple of weeks or so, but the 55.2 on services, not really what you want to see if you're looking for services inflation to continue to move lower. And manufacturing PMIs coming in weak, not only underneath the forecast, but underneath 50, meaning contraction, also doesn't really suggest much improvement on the R-word front, right? Recession. So again, this is not a direct call, but it's probably a call to say that, hey, if you cut rates too quickly, you're going to get inflation roaring back here, and this is still not even responding to your foreshadowing of rate cuts, right? Because the market moves in anticipation of Jerome Powell actually cutting the rate on September, whatever it is. Let's go back to, I'm already forgetting the day, 18th, right? Markets are going to respond ahead of that. And this, is not responding yet. So that to me is a slight concern. Of course, we got his commentary on the Friday session. Let's go out to GDP, because the Atlanta Fed did revise their GDP estimate from like a 2.9s perhaps back here directly to a 2%. So it's not like we're forecasting negative growth, air quotes, yet, but this downward revision, as we're possibly dealing with inflation that might rebound on too aggressive of a rate cut, ties into this concern I've sort of been expressing that a single rate cut is maybe appropriate. Anything more than that, too much. And that's your Atlanta Fed GDP. Let's look forward to, so let's go back to the calendar. This upcoming week, what we want to talk about from a fundamental data perspective, durable goods might be interesting. We'll see how that happens. But really, it's the preliminary GDP as well as continued initial jobless claims on Thursday. The forecast here is currently basically unchanged from this week at 234. As long as that remains stable, once again, I think it's either appropriate for Jerome Powell to surprise the market by saying, like, we're not going to cut rates and we'll cut rates maybe at the next meeting, or we'll give you the 25, definitely not the 50, right? So that's the initial jobless claims there. And then PCE gives us some insight on Friday. The biggest deal for the market is actually going to come in the following week, or the first week of September, right? Monday, holiday, Labor Day, so enjoy that. But manufacturing PMIs, okay. More importantly, ADP non-farm preview of the labor market. JOLTS, right, will be interesting. Initial jobless claims, so it's the labor market week, right? ISM services PMI will give us the proper breakdown to understand whether or not it's inflationary or just an uptick in orders, right? And then the big Monty, the full Monty, is on Friday, September 6th, hourly earnings, non-farm payroll, and the unemployment rate, right? So this, I believe, is what the market's really aiming for next. And sort of in the intro, when we were saying and comparing back to the melt up, in the early stages of 2024, I think without a fundamental catalyst, I think it could be a melt up as we anticipate or await, rather, more information from releases like this, Friday, September 6th being one of those big deals. As we take a look at the earnings calendar going forward, NVIDIA earnings after the close on Wednesday. It's capturing everybody's attention, and rightfully so. CrowdStrike is going to get mixed in there, Salesforce, some lower tier tech stuff that you could pay attention to, Affirm, Okta, Pure Storage, right? HP feels like a dinosaur these days. Dell, another dinosaur over here. So it's all eyes on NVIDIA earnings. Everybody knows that. We're going to watch to see how they come out, and we'll sort of take it in stride. What does that mean from an options trading perspective this week? You're probably going to, think about implied volatility and not wanting to get IV crushed if you're trading NVIDIA. So please be mindful of that and just understand that you're paying an inflated premium for possibly less of a delta move relative to that. Like the percent return is not going to be, it might not even be worth it in some particular instances, specifically on the Wednesday session itself. So NVIDIA earnings, all eyes on it. I don't have any forecasts for this stuff. You guys know me. We'll look at the data in hindsight. I never, ever try to predict what is going to happen on earnings. It's some people can do it, and kudos to them, but for me, it's not worth the research, the effort for a 50-50 coin toss, because you could have a killer earnings report, but if it's worse than the market's expectations, you still move down, right? So there's my brief disclaimer on Wednesday after the close. Let's get back on over to what we do best, though, which of course is just the technical interpretation. Let's jump through some of our supporting evidence. TLT ratio to the S&P I think is worth talking about, because we had this panicked spike, but everything since has been this downward draft here, not really indicating the flight to safety continuing. I would be much more concerned about this market, and I would say, wow, a second leg lower, a big detrimental downtrend could unfold if we made a new pivot high. Does this look like it's about to make a new pivot high? I'm not seeing it currently. Let's take a look at bonds in relationship to themselves. The downdrafts and the fact that they are all in sync now is bullish. It's not just like, hey, we know Powell's going to cut rates, but we're still remaining elevated here. Everything's working out. Again, it speaks to risk appetite being increased. Credit spreads, same concept. Notice that we have a lower high underneath the key inflection point, and we even have a lower low underneath the previous lows here out of the SHY-HYG spread. So what does this tell you about risk appetite? Nobody seems to be overly concerned about a credit event. This would sort of be bullish for equities down below. As we look at the HYG in isolation, this one makes me laugh. I mean, this is the junkiest of the junkiest, right? HYG is quite literally junk bonds. They are risky bonds. And the fact that this is performing well, again, speaks to sustained risk appetite for equities even at this point. You could even jump over to something like the LQD, We did this on Wednesday, where you can see that even corporate grade, not junk, but corporate grade bonds are still getting moves higher here as well. Nice little equal high into that Friday close. So all set out of risk appetite. Bitcoin would reinforce this as well. But I'll stand by this until it changes and there's mass adoption, I should say. It's a risk asset until proven otherwise. And the fact that it's over, let's call it 61K, risk appetite is bullish, not one-to-one with the market, but you guys get the tone. Here's where we can really talk about breadth, and we were alluding to this when we were discussing the market internals. Look at the massive improvements out of new highs versus lows as the market's grinding back into that equal high. Huge improvement there. That is bullish. S&P components over the 50 SMA and 200 SMA, both seeing substantial upticks in last week's worth of trade. Once again, you're not seeing sustained bearish pressure across the components, and this would also be reflected with ding, 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 you betcha, the RSP equal weight S&P 500 ringing in a new all-time high on the Friday session. You tell me. Is it bullish? Is it bearish? This speaks to the broadening nature of the market rally that we've seen so far. To me, this is absolutely a bullish indication. If we look at the QQQE, though, this supports the thesis, or just the general comment we made not too long ago in today's episode, that the NASDAQ is where you want to be looking for shorts. The QQQE, yes, it's like one-to-one with its weighted component or brother down below, but it's not making a new high like the RSP. So the fact that the S&P 500 is a broader index, not just obviously concentrated in tech, although that's arguable, is why it's, in my view, air quotes here. Nothing's ever 100% safe in the market, right? Let's not go down that rabbit hole. But the S&P is a safer long at this point than the NASDAQ, which is so concentrated. And you can see that reflected in the equal weight. Let's jump on into the volatility index. VIX is coming down. Set a lower high. It didn't really accelerate aggressively, like up to 2050, for example, on Thursday's engulfer. So once again, it's a bit more comfortable for the market. As an indication, the VVIX, same comment here. It got to 120, but backed off and is closed underneath 103 on Friday. So volatility, not as much of an issue. If you're someone who also tracks the VIX futures, or I should just say volatility futures, then you should update your contracts over here. We are now in the next month's expiration, but well above contango, right? Over the zero mark, and you can see the same thing reflected here in the monthly versus 9-day, and the 1-day also moving lower. If you did not tune into the Wednesday update video, one of the things we can do real quick together is remember this day. We have November 7th. It's the first time we broke from an elevated 1-day into the lower bound. November 7th, right? Let's go back to the SPY, and let's go back to November 7th. November 7th is right around in here, and the pullback from the market was over. Right? So we just did something similar. We had an elevated 1-day. We dropped down to the bottom of the range. Is it possible the rally, not the rally's over, but rather the rally is going to continue? The pullback is over? Yes. You get a similar indication over here. A sustained period over 1275. You first hit the zero mark on April 29th. It's not really a zero mark, but just the bottom of the range. April 29th is this segment right here. The pullback was over, and we continued to grind in the upward direction. When I was talking about a melt up earlier, I think that this is a supporting piece of evidence for that sort of thesis based on the 1-day. Let's jump into our core list of companies. Let's get the job done. I've got 2 additional ideas to share with you after this, and then we'll wrap it up. You can enjoy your weekend. What do we see out of Microsoft? I like the fact that we are getting consolidation here, and I like the fact that there's a longer lower wick on the daily bar underneath 416. There was an attempt to get over, right, for a brigade bolt here, and I think that this lower wick gives us, to me, it's a failure of the sellers to go lower, right? Basically, what happens is you make a new bar-to-bar low, but you close back inside of that Thursday range. So as long as Microsoft is over 416 in the early stages of this upcoming week, I would be thinking about rotations into the equal high, if not higher high, into this previous pivot. That's what the daily looks like to me. You've got a point A to point B with a pullback to C now, and as long as we can hold that key level, I think you're at least back to B, if not, let's just call that D over time. Not to get too fundamental with our alphabets, but you get the idea. What do we see out of the Friday close, right? If stronger sellers were here, that would have, in a more bearish market, yielded a lower high underneath 416 for a close under. So we'll keep very close eyes on it. I'm not just saying blindly long this thing as soon as the market opens up on Monday, but you could start to envision how maybe like hourly inverted head and shoulders, here gets you back here and then there for that point B retest we were just describing. So bullish on Microsoft over 416, under 416, call it for what it is. I think that a stronger retest of your breakout point around 408.75 is definitely in play. Notice the equal highs that led to this move. So daily 200 SMA as well. Microsoft's a really interesting watch around these two key levels, 416 and 408.75. Definitely captures my attention here early on. Apple really struggling to break out of this balance range. It couldn't do it on Wednesday, Thursday, or Friday even. If you take a look at the hourly time frame chart, here's the original range. There's your attempt early on Wednesday. Thursday gaps up, no gap fill reversal. And on Friday, broke through, no high or low above. So cannot break on through to the other side quite yet on Apple. You guys know the band. Put it in the comments section. Any consolidation in here is just neutral. We'll give it sort of as many opportunities as it would like over 227, but at a certain point, if we're just consolidating after these three failed breakouts, I'd be very, very open-minded and willing to short Apple under 222.50 into like a 218.50, 214. You can only fail a number of times before it's like, okay, enough's enough. Any sort of weakness, and we're just sort of jumping on the opportunity. So that's Apple. Next up is NVIDIA. As we talked about, earnings are right around the corner here, Wednesday after the close. So be mindful of your options implied volatility. As a matter of fact, what we'll do with you right now is just throw on the options selling sets. And IV rank is actually a little bit suppressed from where we were on the August 5th panic, if you will. I'm curious to see whether or not this increases early on in the week. It's not really, relative to this is always speaking in relative terms. It's not as bad as it was. So we'll continue to monitor those premiums. But for now, I thought it would have been worse, if I'm being quite honest with you. Something like an 85, 90% IVR. Not the case. Anyways, let's bring back a normal study set. There we go. And we'll talk about the chart. So, lack of follow through on the bearish engulfer. You closed underneath a pretty key level there. Double inside bar could not break out, failed, and now you're right back inside. So, what's the name of the game? I would tend to think bullish consolidation, and any breakouts over 131.50 equal high here, possibly all-time high 140. I think you're going to get a lot of speculation before earnings. Of course, remember what we said earlier, markets have a very short memory. The two previous earnings cycles, which really defined AI Mania 2.0, is bullish, right? People, if the market gaps up, great, right? Kudos to everybody who's like, oh, look, previously it gapped up. Great. If that's your approach, you do you, but you guys know me. I'll be taking the risk-first approach, which is to say, hey, do not want to hold options through that. I've got some tucked away in the long-term account. If it gaps up, great. If it gaps down, fine. Doesn't really change my multi-year thesis unless there's something crazy in the report. But anyways, from a technical perspective, I like the high and tight consolidation. Obviously, huge recapture here. Any higher lows were available over this 118. The fact that the sellers couldn't even pull back after Thursday, it's got to be bullish in the short term. That's my take, at least out of it. I would only change my tone to bearish, just to play devil's advocate, on something that looked like this. Lower high beneath that 118. Next up, Google. Google's the weakling of the bunch, and we've been talking about this, but generally it never got in gear off of the August 5th low. Could not squeeze to the upside, could not play catch up to the remainder of the tech components or even the broad market, and now it's starting to suggest a possible lower high here. From there to there, that would be like a weekly lower high because the daily is a higher high from here to here. But if we break down underneath this 164.75, I think Google's the weakling that we might want to pick on a little bit here for shorts. So consolidation that's below 166.50 with breakdown lower highs under 164.75, target 161.50, the midpoint of the range, this origin of that rally. And really, if you want to go full bore on it, it's going to be look above and fail. Right, target should technically be the bottom end of the range at 156.50, and we would aim for risk reward that maybe looks something like this. So that's Google in a nutshell. I would not really be bullish on it yet until it's back over 166.50, possibly giving an equal high breakout over 169 to target the stronger inflection at 173.25. Amazon, what's going on with Nancy? Let's go back to a daily chart. These daily bars are pretty important here. Overall downtrend. You guys know me. I'm not a fan of a trend line, but when they're this precise, it's at least worth calling out. I would tend to think that there's a short-term head and shoulders that could develop here underneath 176 for a possible gap close, 200 SMA test. Even like any higher lows out of Amazon walking forward off of 168.75 look decent for the daily trend to try to make more of a stand. And your second test after a higher low, like here, would be the more constructive break of the trend line. Any continued consolidation, let's go down to the hourly now, actually. Ooh, look at that. On the hourly, oops, sorry for the zoom craziness. On the hourly, it's actually starting to suggest a little bit more of a man ray, perhaps. There you have it. So there's your gap close. That's that 176 breakdown we were just talking about. But if you're going to get constructive to the upside, it's really got to clear this area, because remember, 180, which has been removed since the gap closed all the way and we have new levels, but 180 was a gap close. So the fact that like you've got this we call these power lines, right, where there's just a lot of resistance, daily 50 SMA is there, I'd just be very cautious. Like day trade scalps, sure, be my guest from point A to point B, but for longer term longs out of Amazon or just higher confidence longs, you probably want this. Higher low over, Brigade Bolt over 180-140 is now the new level. Let's jump on over to Metaverse, see what's going on with Zuckerberg's Fantasyland. New all-time high technically on the Thursday session. Putting in this consolidation though. So starts to look more to me like look above and fail. Already moved to the bottom end of the range. Very, very cautious around 524.25. Here it is on the hourly chart now that we can understand that. This, I mean, let's not get too crazy with patterns, but there's maybe a head and shoulders. So if you sustain a lower high underneath that neckline, or even if you just want to consider this to this as a lower high, bearish consolidation, and I'm pretty concerned for overhead supply to engage when and if we break that 524.25 we were just mentioning. Thin structure here, absolutely. That's a no-brainer. Day trade scalp, right, into 524.25 into 517.25. And then beyond that, I would certainly be putting my daily higher low thinking cap on up against something like your 503.50. It's your daily 50 SMA, and you can see it here, fine. 1, 2, pull back. Maybe it's like a daily double top or whatever. This, then I would be thinking lows, higher lows. I mean, the metaverse is one of the first names in the tech cohort to make it right back up to all-time highs outside of, ironically enough, Netflix, right? So thinking about that out of this particular chart, 524.25 is the key level. Consolidation is bearish until proven otherwise. Under 532.50, watching for the breakdown here, daily higher low pullback for 503.50 test. Any consolidation that does not break and possibly gets over 532.50, I would let this set up a bull flag or whatever, and then Brigade Bolt it into all-time highs. Tesla, what's going on with Mr. Musk? How are we making out over here? You got to give credit where credit is due. The failure of the engulfer, just nasty close on Thursday to really get any follow through into like the breakout area here, 202.75, is pretty impressive. I mean, maybe a pie in the sky, inverted head and shoulders, and at that point you'd probably have some sort of trend line as a neckline. But I like if you just draw this out. This was the original gap down range on earnings, right? I like that we held inside of that 215.25 on Friday. So consolidation here does its thing. I would Brigade Bolt there, basically just a higher low out of those highs. Over 226, bottom end of the gap here, 234.15. Gap closes 246.25. If we were to pull back a little bit further, there might be a short in there, but if you take a look at the hourly, my concern about the short unfolding is now you have support here, you have this, you have this. There's a lot to battle on the short side with these particular levels in between what appears to be the larger range that's available to retest 202.75. So I've got some reservations about trying to short it. Once again, if sellers were going to make something happen, the open on Friday at this level should have yielded like lower high consolidation and then the flush to get there. It just didn't happen. This consolidation seems more bullish than bearish to me. Next up, JP Morgan, just like the XLF financial sector, huge break, new all-time highs. A little tricky to trade it on the Friday session, if I'm being quite honest. The risk reward was not ideal up here. But regardless, the chart is bullish. So any holds over 215.75, you're just looking for those long opportunities, looking for bullish trades up here. The only time I would be bearish is not even on a move underneath 215.75. It would have to be under 213.25 for a thin structure retracement. Here that is on the hourly. You guys know that we've been tracking the V-shaped cup and handle, which I don't know how your mug is supposed to balance on the desk if it's got a V-shaped bottom. Neither here nor there. But your breakdown has to be this, right? Thin structure retracement during this move to accelerate. So 213.25 is the only time where I would really change tone to being more bearish. Next up is Netflix. As we were saying, new all-time high earlier on in the week. That was, Tuesday? And starting to pull back, but mildly. I think that's totally warranted after a point A to point B. It's just doing its thing here. So what's the name of the game? Let it bull flag, and then sort of constructive looks would be over 696. If we take a look at the hourly chart here, if we could recapture this really tight range and sort of get consolidation there, that's where I'd be looking for that breakout over like a 701. The level is honestly, let's remove that. It's no longer really in play. The level is really this right here at, let's grab the right number. We could round that up to a 50-cent mark on a $700 product, sure. So something that looks like this and then there is where we're looking to execute those long trades. If you wanted to try to say, hey, I'm buying the daily pullback and like getting involved on something that looks like this, tight risk here into those highs, it's a possibility. I would just sort of be mindful of the fact that this is You always got to be careful calling something overextended. Markets can always, what's the classic saying, stay irrational longer than you can stay solvent. So I wouldn't just say like, wow, it's got to pull back, it's got to offer something more constructive, but this would also be a great opportunity, if I'm being quite honest, off of 663.75 if something deeper did want to unfold. Last but not least, before these two additional ideas, which are going to look familiar, we have AMD. And I like the consolidation up here. I like the flag. This is like even better as a cup and handle than maybe what we had out of JP Morgan. So as long as we can consolidate up here, I think that this is bullish consolidation. And we'll have to change our tone for some thin structure retracement up and over 159.25. You guys know for a while, I was sort of skeptical of AMD just because this distance was much more severe than NVIDIA. This breakdown was more aggressive than NVIDIA. I was sort of more along the thought process of, all right, where's the lower high so we can continue to short this thing possibly. So, that tone has been changed. And I think rightfully so, since we've recaptured some of these volatile opens at 150.75. So that consolidation, as we just pointed out, bullish cup and handle, looking for the follow through over 159.25. If it's going to be like, wow, Matt, you're flip-flopping all over the place, dude, figure it out, pick one, then in here I'd be a little bit more neutral, definitely more bearish underneath the 136, just noting the failed breakout, right? So something that would look like this is probably where we'd say, okay, at least an equal low. If not, here's highs, lows equal lows. What's the next step in a downtrend? Some kind of lower low, right? So anyways, that's AMD in a nutshell. Two trade ideas for you. SMCI, is that familiar or what? Man, this thing did absolutely nothing last week. Just completely sideways inside of the inside bar range. There's the inside bar. Here's more inside bars. So continuing to watch this as, yet again, another cup and handle. It's not quite like if we look at something like MU, we had said that there's a family of these setups. So MU sort of broke down. I would be watching this one for a look below and fail. If MU is going to offer a bullish setup, you're just looking for this. This right here, if you could spot that higher low and the semiconductor space is not getting absolutely obliterated on NVIDIA earnings or something, that higher low over 105.30, who let that slide? Who let that slide? Let's go 25 on that, and let's go 50 up here. Round numbers only. You guys know the rules. Something that looks like this is probably what I would interact with, as long as NVIDIA earnings go fine. So that's MU. AVGO was another one sort of with a similar look. If we just go to a daily chart here, you're sort of getting not really a cup and handle, maybe something like that. The breakout's a little less interesting here. I think that the best looking chart is SMCI. So that's really going to continue to be a focus here. A very familiar chart. We've been talking about it, but it's going to continue to be monitored. So that's SMCI. Next trade is on BA, Boeing Airlines. What's going on with Boeing? Boeing Airlines, BA. This it's a classic attempt to get into an overhead range. Tried here, failed quite quickly on the Tuesday session, and this lower high is now what I'm looking at. So shorts underneath, there's a couple of ways to do it actually. You could take the short underneath the low of the Friday bar, which is 173 flat, round numbers only, there we go. And then your target would be like the equal low in here, or you could say on the hourly, you could use something like a trend line break. You could get involved under that and say my first hourly target is here, or you could even say I want to see it back inside of this lower range, which is at 169 flat, if we grab the round number on that, right? So you could say, all right, break, lower high, great, that's bearish, but I'm going to enter the short as we're here. It's a little bit less attractive to me because, first of all, you're trading it, you're getting short at the top end of the range. It's possibly an area for support. The best place to be short would really be, if you could get risk reward that looks like this, and then balloon runners into maybe the bottom end, closer to what's the level here just to get you something? We've got 162.50. 162.50. But generally speaking, Boeing looks more like a short to me based on the daily chart, failing to accept inside of this overhead range, breaking down for a lower high, just trying to find some opportunity to get back down into this equal low. That is going to do it for me on this beautiful Saturday morning. I'm excited to go enjoy the rest of the afternoon. Hopefully you are as well. Have yourself a green trading week upcoming. Remember that we will be live up in the penthouse every single day of the week. I want to say a big shout out as well right now to every single one of you who has subscribed. We hit the 100,000 subscriber mark into the end of last week. And just very grateful for the community that we've built, of course, everybody who tunes in, all the comments, everything. So thanks for coming out to the show. Thanks for supporting the channel. We'll continue to keep growing. Keep your eyes peeled for some 100K merch at some point. Got to figure out what it's going to be and how it's going to go out, but we'll get something done. We'll have ourselves a good time up here in the penthouse. So, as I said, have a green trading week, and of course, I will see you in the next one.